Okay, so now that everything's really rolling over and everybody's kind of on board with what's going on, we're going to talk about what happens next. And that's not too hard to predict because it's all based on the same stuff that got us to why it's rolling over in the first place, right? So if you understand and know why we are rolling over, then you understand and know what's going to happen next. And that's what we're going to get into today. As always, I timestamp my videos down below so you can skip to the part you're interested in if you don't want to hear this. But I would encourage you really to hang around, because this is the kind of thing that kind of gives you an edge over most people. Most people don't take the time to understand this. You know, they might read a Reddit post or something about, uranium being bullish and here's why, and then they get in, and then they don't understand why the market's rolling over. And that's, these are the kind of people you can easily beat in the market, all right? And this is what I'm here to try to help you do. So today we're going to start with the federal funds effective rate. Up to this point, we have been talking about every single video since the start of the channel. Pretty much, we've talked about the 10-year. We've talked about it breaking this 41-year trend. This is why everything is breaking. This is why everything's rolling over. This is why you can expect more pain, okay? Now, by the same basis, we know what's going to happen next, thanks to math. So we're going to break this down today. We're going to start by introducing you to two men you may or may not know already. The first of which is Luke Gromen. If you don't know who he is, I'll type his name below in the description box, and you can follow him on Twitter. He's with Forest for the Trees. This is a really great macro mind. We're going to watch this video today. I had already retweeted this on Twitter a couple days ago or something, shared with you guys. And this is the same video, and we're going to watch it and hear what he has to say and break it down, okay? This is going to help kind of give us a nice segue into the entire video. Now, the second would be Mr. Mike Maloney. Now, Mike Maloney is a gold and silver guy. Now, we've talked about the Pareto principle in the past, so even though you're here for uranium, and I know you probably are because YouTube tells me, right? It's about 77% of you guys come here for my commentary on uranium. So there's just another example of Pareto principle at play, by the way. This guy has an excellent series that all of you, including you uranium people, need to understand, all right? It's called The Hidden Secrets of Money, all right? And episode number 5 in particular talks about where does money come from. In a nutshell, money does not exist until it is borrowed, okay? So money doesn't come into existence until it is lent into existence. And if you didn't understand that, you really need to watch this video and get your head around it. This is what I alluded to in the past when we talk about the bond market in the first place. All right, the price of debt is more expensive than it's worth. Okay, so this is why debt is collapsing. We're in a debt-based system, right? Money comes into existence when it is borrowed. As the price of borrowing goes up, fewer people are going to borrow, and the system just collapses on itself. Okay, the system relies on nonstop borrowing, nonstop issuance of debt. That's why this is such a big deal. If you don't understand that, that's okay. You can watch this video and get your head around it. It's extremely important, and it will really, really get you ready for this. In fact, if you don't know this, if you don't understand anything I'm talking about, just turn my video off. Don't even watch it. You need to go watch this. Okay, give this guy the view, give this guy the attention, because this is going to benefit you far more than anything else I'm going to say, because this is really the foundation you need. But with that being said, we're going to start with Luke's video here in just a second, and we're going to play little bits and pieces of it, and then I'll kind of break it down and just make sure you understand 100% what exactly he's saying, okay? Because this is very important. This is the big setup for everything we're about to talk about. So here we go.
The U.S., the world is coming to I think we're living through the first bursting global sovereign debt bubble in 100 years, right? And so if we look back in time, 1999, we had a stock bubble. It burst. Policymakers kicked it upstairs to the banking system and the housing market by virtue of creating a housing bubble to offset the lost demand from the stock bubble.
So what he's talking about here is that when the dot-com bubble popped, Bernanke lowered rates to try to stave off the declining asset prices. I mean, everything was crashing, right? And so theoretically, what you can do is you can lower interest rates, because by reducing the cost of money, you can encourage borrowing. And when people borrow, they spend, and you can either support or reinflate asset prices this way, okay? So that was their method of fighting off the crash, was by lowering rates. And all they really did was get rates low enough that it encouraged too much spending and too much borrowing, okay? And it gave birth to a brand new crisis, which was the housing bubble.
We have a housing bubble, it bursts. They kick that problem upstairs to the sovereign debt level by virtue of the backstops put in place by the American government, foreign governments of their domestic economies around the world.
So what he's talking about here is that once this bubble popped, they lowered rates again, okay? And they lowered them extremely low to try to fight off the great financial crisis. And this is multifaceted. So first of all, it's similar to the dot-com bubble and lowering rates, okay, and trying to stave off the crash. But it's bigger than that because then they took policy action too, right? It's the too big to fail. We're going to bail you out. I mean, this was that whole bailout principle was born here, right? And so this is the backstop that these companies don't have to worry about anything. They're never going to fail. Well, this, of course, incentivizes bad behavior, because if you're going to get bailed out, if you know a sovereign government's just going to print money or steal it from you, the taxpayer, in order to pay off their bad decisions, then it kind of mitigates your own risk, right? You can just take a bunch of silly risk. So this, coupled with these insanely low interest rates, right, making money effectively cost to nothing, you have taken these prior burst bubbles and effectively rolled them into a brand new bubble, except this time it's a super bubble, okay? Because this time it didn't get rolled into housing. It got rolled into government sovereign debt.
Define the terms if you would. So sovereign debt is what?
Just debt, written debt of a government. So treasury bonds, Bunds, but in the Germany.
So this is not your credit card bill. This is America's credit card bill.
No, this is America's credit card bill, and it's unsecured. This is full faith and credit. It's just back full faith and credit, right?
It's unsecured, full faith and credit. Do you understand what that means? It means the dollar's not backed by anything. These bonds are not backed by anything. It's just faith. It's faith in the government. It's faith that not only they'll pay it back, but that it's worth something because it's backed by the government. You understand that doesn't even hold any value whatsoever, right, in real terms. But people believe it does. So because you believe that the currency has value, you use it and other people accept it, okay? So where it once was backed by gold, right, and it had some kind of intrinsic fundamental value to it, right? The currency was just a representation of something else that actually had some kind of value. Fiat currency has no value. It's simply faith, okay? So what happens when people begin to lose faith in their currency?
Today, too, money is a question of confidence. So the currency, today isn't money. Today we're using currency, but the only reason it has any purchasing power whatsoever is because yesterday your experience was that it purchased something. So you have faith that it's going to purchase something tomorrow. Otherwise, it has no value.
It's like you get to the point where you show up to buy something with a wheelbarrow full of money. And they're like, no, I don't even want the money. Just give me the wheelbarrow, right? Kids are going to be using piles and stacks of it to, make houses of cards, right? Because they're just toys at that point. Stacks of money become toys, just playthings. You use them to, throw them in the fireplace to keep warm. It's worthless.
Right. So the good news is we haven't pledged Yellowstone to the Chinese.
No, exactly. We've not pledged anything to anybody. It's all unsecured. But it's like the old Superman movie when we were growing up, right? Is with Superman with Christopher Reeves and Lois Lane, where she's falling out of the building and Superman catches her and says, "I've got you," and she says, "Well, who's got you?"
So what he's saying here is that now that the problem has been kicked down the road to the point where it's reached the federal government, okay, it's reached sovereign debt levels, who's going to bail out the government? Okay, and his answer is...
Right, so if you go, okay, if we've kicked it from stocks up to the banking system, up to the sovereign, there's nowhere to kick this up to. Unless the Martians come in and write us a check, the only place to kick this up to is via the currency, via devaluation of the currency.
Bingo. And that's kind of the answer. This is where you're going. This is why when people talk about the Fed fighting inflation, people often misunderstand. So where the market's focused on raising rates to a meaningful level, which they'll never do, and we've talked about that before, they can. It's mathematically impossible because you'll default on the debt. For every 1% you raise rates, you get $300 billion in interest debt payments, okay? So you can't raise them enough to matter, therefore you're cornered. The only way you can fight inflation is to inflate your way out of it, all right? So you have to make the nominal debt worth less so that it can be paid off, right? It's like if you have $100 worth of debt and you double the amount of currency, well, then you effectively have $50 worth of debt. Does that make sense? You've halved your debt. Even though it's nominally the same amount, it's factually only half as much because now there's twice as much currency out there to pay for. Does that make sense? And this all loops back around to what we've been talking about and building up for so long on this channel about facts versus narrative. So over here you have facts, and over here you have narrative. So even though the reality is that the Fed can't raise rates high enough to do anything about inflation, the narrative is that everything we're going through is a basis of the Fed fighting inflation, but the Fed can't. They cannot do it. Okay, so that's the fact. All this narrative, all this talking about the Fed raising or not raising or raising a little bit or a lot or whatever, it's all noise. Okay, it's just noise. Noise that's pushing the market around. Because the fact, the reality is that they can't fight inflation. Why can they not fight inflation? If you've been watching the videos, you probably know already. You can't raise rates too high because if they get too high, the payments on the interest become unaffordable, right? So the federal government cannot make the payments because if you have $4 trillion worth of tax receipts, okay, that's the income that the federal government has. All right, and then you have about another 2.7 or so in entitlements to spending. All right, that leaves you 1.3. Well, if you have to spend $300 billion, okay, $300 billion, not in debt payments, but in interest on the debt payments, for every 1% that you go up, how high do you think we can go? Do you understand? So obviously, mathematically, this was never going to go that high. This is all narrative. This is all talk. This is all jawbone. This is why, guys like Peter Schiff, a lot of people make fun of him, but at the end of the day, he is right. Now, you can call him a broken clock if you want, but he is right. Like the day is coming where it's going to be Schiff o'clock, right? Like he is fundamentally end of the day, end of the road correct about what's coming, which is that the Fed can't do anything about it. So what do? Well, they have two options. They either go ahead and let it raise as high as it needs to go or will go in a free market, okay, and just let the government default. And there's only one other option, and that is to go QE5. What is QE? QE is quantitative easing. Quantitative easing is when the Federal Reserve prints money and buys bonds. When they buy bonds, it lowers the rates, right? And that sustains a bull market. Okay. And in case you don't understand why this is a bull market to go down, it's because if you bought this treasury up here, okay, and now it's down here, well, now it's worth way more because the one you hold has a substantially higher interest rate than the one down here, right? So it has a higher yield, so it's worth more. Okay, so if you were to go into the free market and buy here, right, then it would be at a lower interest rate than the one that I could give you that I bought back here. You understand? So it's kind of inverse. It's a little bit counterintuitive at first, but it makes perfect sense. Okay, so what does that imply then? What does it mean if the Fed is going to inflate their way out of the debt? It just means that they're going to start QE5, they're going to print, and they're just going to expand the money supply so that whatever they owe nominally in debt, it's going to be reduced. It's going to, right? You're going to pay off your debts with dollars currency that's worth less than it used to be because there's more of them in circulation. So what does that imply? Well, it implies that we're probably at least going to have stagflation. All right, and stagflation is when you have an economy that's slowing down or going backwards at the same time that you have high levels of inflation. That's stagflation, stagnated economy with inflation. All right, it's a terrible combination. Happened in the 70s. It's happening again. And in the 70s, you got to understand that their response was to raise interest rates, right? Volcker raised them up to 20%. 20%. All right. And he immediately shut the inflation down, to shut it off, right? Because people quit borrowing, they quit spending, the economy rolled over. They artificially induced a recession, right? They put the economy into a recession on purpose, right? And it worked. The reason they can't do that today is what we've been talking about already, is that the debt is too high. In the 70s, we didn't have the kind of debt that we have now. I mean, here's a chart to prove it. I mean, look, it was mid, late 70s, early 80s, okay? So here's the recession. So, back then our debt was 30% of GDP. I mean, that was good. And now, it's 123. It was as high as 135. So our debt is higher than what we make, okay? It's like, imagine what that would mean for you if that was your situation, right? Think about your monthly bills. If your monthly bills were more expensive than your monthly income, you would be in big trouble, wouldn't you? Okay, well, that's the problem that the federal government's in. All right, and the only way they're getting through this is by printing money. So what do you think the answer is? Just to put this into perspective for you a little bit better, here's a chart showing the federal debt. This is our total public debt, okay? This is what happened after the dot-com bubble burst and they lowered interest rates like we showed you back here, okay? When they lowered these interest rates and started this housing bubble, look what happened to our debt, all right? It just started shooting up. I took the liberty of making a picture for you to illustrate that had we kept on the same plane, it would have been somewhere down here by this point in time. But that's not what happened. Clearly, after the year 2000, when they started that bubble, they started something that they could never contain, okay? This is a long time coming. We are now in a super bubble. We are not in a dot-com bubble. We are not in a housing bubble. We are in an everything bubble. Everything is overvalued. Everything is inflated. And everything is at risk of crashing. This is what makes commodities such a good play. And if that doesn't make sense to you, I'll explain. First of all, not only can you see how bullish things are when you just open a chart, I mean, look at how bullish gold looks. Look at where we're projected to go. You combine this with the fundamental facts that we've been talking about, which are not lost on major investors. Okay, everything I'm talking about is public common knowledge. It's public knowledge. It just may not be so common, right? Like your neighbor probably can't go over a lot of things that we just talked about, right? But these are certainly fundamental truths that most market participants understand or are beginning to understand. So you can take a chart like this and overlay it on top of these fundamentals, and it just shows you where we're going. Of course, where things like gold will protect you from the destruction of fiat, silver will too, but silver is an industrial metal, as is copper. Okay, and these things are just going to explode higher as we print money, because this printed money will be used to support the economy that would otherwise be collapsing on itself. Of course, it's not just because we're going to print money that's going to chase goods. It's because we're artificially reducing the availability of supply with stupid sanctions like the ones we have on Russia. We're cutting off oil, we're cutting off uranium, we're cutting off wheat, we're cutting off potash, we're cutting off fertilizer, we're cutting off natural gas. What do you expect to happen to these prices? Not only that, do you think that this is going to end? Do you think that Biden's going to roll over and admit that he's a moron, right? And doing all these sanctions? Of course not. They're just going to double down. If anything, these problems are going to get worse. They're going to print so much money and expand their balance sheet so much that even things like Bitcoin are going to get another leg up. You think fertilizer and agricultural companies are going to keep rolling over and collapsing when we have a food shortage that we started for ourselves with all of these sanctions, cutting off wheat, cutting off fertilizer? Do you think when South America can't produce the yields of their crops that they're used to doing because they have no fertilizer, that these companies are going to collapse? Ooh, look at this one. The war in Ukraine has left the world not only short of important grains, but also fertilizers. This could tighten food supplies. First of all, it's not the war in Ukraine that cut all these things off. It was the sanctions. Farmers are seeing prices for fertilizer skyrocket. Yeah, that's because we cut off natural gas, which is a fertilizer, which is a byproduct of natural gas, by the way, if you didn't know that. Potash, all these things, most of which come from Russia. Some may choose to rotate crops or use less nutrients, which could reduce crop yields. What do you think is going to happen? You really think that American shale is not going to have a boon when we have to substitute for all of this missing oil in the market? And they're already telling you how they're going to do it. And they're already telling you how much it's going to cost. Because remember, what have I tried to tell you so many times? That the world doesn't run on fact, it runs on narrative. So automatically you can know and assume that there will be a narrative in which to transition into this era of spending and deficit. And it's going to be an excuse. And what excuse is there greater than the climate? They've already told you that net zero, which they're actively pursuing, this is why you want to be in energy, this is why you want to be in uranium, this is why you want to be in silver and most commodities, because they're going to use the hell out of all of these things to build all of this infrastructure, a price tag of which will be about $150 trillion. It'll be about $5 trillion a year over 30 years. This is how they're going to do it. They can't just print money and say that they have to print money to get themselves out of the corner they've made for themselves. They have to print money with an excuse, and this will be the excuse. This will be the narrative. It's to go green. It's to save the world. And it's not like it even stops there. I mean, this thing is like Shrek, right? It's like an onion, and there's always another layer beneath the layer you just peeled. Look how much of our currency was printed in just the last couple of years. I mean, this is monopoly money. So this goes back to faith. I mean, at what point do people begin to lose faith in this currency? I mean, it is inevitable over enough time, which is how you know that this money's going to seek out real things, so that when it does collapse, what you're left holding are things of value, things with intrinsic value, things that are real. And of course, what better place to go than commodities themselves? So it doesn't really matter how you peel it. At the end of the day, we are facing an inevitability of higher commodity prices. It is baked into the cake. So you want to be in and you want to buy. And now that we have gotten the sell-off that we anticipated, we can start making our entries into these great prices, because I can tell you that we are quickly approaching some prices that may never return. So we're actually going to start today with Centrus Energy LEU. We have been talking about this $20 price level since back here, all right? So on that last earnings call back here, that's when I sold, because I listened to the call and then I read the call, and I sold there, all right? And I made a video about it when I sold out, all right? And I said, I'm not touching it till we get back here. Predicted every move ever since. I said you probably would get a bounce here. I said you'd reject here. We'd rejected not once but twice and been going down ever since. I talked about the H pattern here, all right? And I said you were going down. And I said this was the price target. And look at where we went. I mean, we hit it on the tick, on the T. I mean, we were off by a couple of pennies. Like what? Just a few cents. So I did buy there. It's a 25% move in a day. And so congratulations to anyone who, played the strategy, had some cash for this and was waiting for this opportunity. That being said, I may get out. I mean, I might not hold it. I don't know what I'm going to do yet, because there was an earnings call here too, all right? And I want to listen to see what they have to say. I want to see what their input is on the current SRUUF situation and all that kind of stuff, and see where they're going to get their supply from. But we'll follow up on that. But for now, it was a great swing trade at a bare minimum. So SMR is looking pretty good. At the end of the day, fairly strong. It outperformed the sector. The RSI on the daily, while that doesn't always mean a lot, it does look good because it's setting higher highs and higher lows, as the price itself is more or less moving sideways. That is somewhat of a bullish divergence to the upside. And being that it has a low float and outperformed, I think all things considered, this is looking pretty good. That being said, you don't have to FOMO into it. You can see how things play out on next week. You might still get a chance to get in on the averages. I mean, never FOMO. Just see what happens, see what shakes out, and see if you can get in at a good price. Next up is NextGen. You can see that it fell out of the channel, but not necessarily to worry yet. You can see it's done it before. And also, we're not quite all the way down to that true technical Wyckoff spot. Now, we did hit our price target by a penny, and we did add here. I added here, followed my own words and added here at this spot. This is a strong buy for me. I think that this is probably your maximum low at 411, but certainly this is a strong area to rebound. And the reason that I picked this area here as opposed to the Wyckoff spot is that some of these, like we talked about in the past, are just going to be more bullish, like Cameco has been, okay? It's going to have a lower rate of descent. It's just going to be a little bit more stubborn hitting some of these price targets. And so you can use this kind of discretion and discernment to adjust, okay? And so I adjusted to this level based on this horizontal support here. You see how we go back to the top of this W, all right? Because we had a double bottom W here. That's what I based it on. All right, and that's obviously where we bounce from. Now, you still technically have the Wyckoff if you get another leg lower, just so you know, FYI. That's why I showed you guys how to do it, so you could do it yourself. But just to let you know, I was a buyer here of NextGen at that price. I was also a buyer of Global Atomic at our lower bound here. I got in 265. I put up a little bit above because I didn't know if we'd get there. Totally happy with the purchases. Dennison, our lower bound was 118. I didn't have this trend line, I don't think, in any of the previous videos, but I did put it in there after someone had tweeted me about it. I took another look and saw it. So I put it in, and when I saw it touch, I got pretty interested. And so I got in at 115 here on Dennison. But the most important of all is Cameco, like we talked about in the last video. As the industry leader, it is the most important to see bottom out. This is why I was saying that you will see the market continue to trade down or sideways until the leaders catch down. The rest of the market's not going to take off until the leader catches down and gets support. And it's just not going to rebound in the middle of the air. It's going to have to come down and find solid support. Remember, our 200 on the daily was the first target, with the 50 on the weekly being the strong rebound. And of course, I have this historical precedent that we always fall at least on average 30%. That puts us, let's see where we are, 30%. So we are down 29%. All right. So at that point, I put out a tweet. You can start buying. Okay. You can start getting in real strong here, because even though we might have a little bit more downside, it'll be minimal for here. Okay. Most of the pain, I think, is done. All right. Most of the damage is done. Any further downside would be slow, I think, and minimal at most. We're talking maybe 5%. I think this is where you can really start to add. If you're holding large cash positions, you can really start taking advantage of these prices. Not to say you need to FOMO at the market open, right? There's still plenty of time for us to come down and test. In the past, we have always at least touched that 50, which we haven't done yet, all right? Or we've come down and touched that trend line. So if you want the best possible price, there is precedent for you to continue to wait a little bit longer and see if you get those touches, all right? Otherwise, if you're spending here, there's nothing wrong with that. It is a very good price for a long term, especially if you're, willing to let this money go for years and let it grow. I mean, this is why we're here. And of course, there's Sprott Physical. This is a solid buy here. I think essentially what you're doing is, if we zoom in and look at the daily, so we've talked about Wyckoff, right? You guys understand that now. You understand what it looks like. Well, when you're accumulating in phase one, it kind of looks like the same thing in reverse. So it's very likely, I think, that this is an accumulation phase, okay? And how long it lasts, nobody knows. Nobody can tell you that. But I just want you to know, in my opinion, I think that's what's happening here. So where the other Wyckoff goes like this and they sell on you up here, right? Does that make sense? Now we're kind of doing the opposite, where we're going to come down here, and now people are accumulating for the next leg up. I think that's what's happening here. I think anything in this range is good. Anything around 1260 is good. Anything below 1260 is great. And just, accumulate the best you can. This is the time to buy, all right? While everybody's afraid, while everybody's freaking out. Remember what I said in my video? My last video, well, not my last video, but when I told you what it would be like, how long this sell-off would take, and what it would look like, I said, right about the time you feel like, oh my God, could it possibly go any lower? This is awful. That'll be right about the time you need to buy. And that's pretty much where everybody is. So while everybody else is freaking out trying to guess at what the market's going to do next, not only did we see this coming in advance, but we had our buy targets in advance. So not only should we have not freaked out by the sell-off, right? We should have had our cash ready to deploy, and then the confidence to use it when we got to our price levels, right? So I hope this has been a really good real-life example of how to properly trade the markets, okay? So you educate yourself on these fundamentals, like the theory of reflexivity and all these things we've talked about, right? And then you put them into practice, right? But you have to do it with confidence. And then when you get to your price levels, you buy, right? Because if you don't buy, then why did you make those price levels in the first place? Okay, so this is kind of what I want to show you in action, how it's done. And I just hope that it gives you the confidence that you might lack to strike. And of course, part of that is the confidence to be patient, right? Not to FOMO, right? Because we talked about how it would come down, it would start going up, and you might think, oh my God, it's rebounding, and then you FOMO in. I mean, look at this, a 10% move. A lot of people got faked out, right? But where did it go? Right back down to where it started. Like we said, the lower target would be. There's no real reason to go across the board and look at every single equity in every single sector, because it's all telling the same story, right? If you've been watching my videos to this point, we've talked about the confluence in the commodity sector for a long time, and they're all pretty much looking the same way. So what you just need to do is, now that we've gotten here, now that we've gotten confluence, especially with big names like Cameco and Uranium, that was so stubborn, it just didn't want to get down here. Now that these big players have found their first major level of support, you can start buying with confidence, because now we have confluence throughout the sector, not just in uranium, not just in silver, not just in gold, but across commodities broadly, right? Everything's finally starting to hit. And even if you look at the broad sector, this is a confluence with NASDAQ hitting its first major level of support. I've had this line here since, like February, okay? So it would not surprise me to see a bounce here. Whether this is the final bottom, we'll see. We're going to analyze, but I'm just telling you I'm buying. And here's the strategy you use from here. So this is the strategy we need to have now, okay? You never have all your eggs in one basket. And when we get this rebound we're likely to get, if you are overweight something, or if you really screwed up on a bad company, or you realize that some of your companies are going to end up being a lot better than some of the other companies and you're a little too diluted, then the bounce we get is a perfect opportunity to kind of redistribute some of your wealth, okay? So if you're a little underwater on some things, you wish you could have it back, then the bounce we get is a good opportunity to sell those bad things, all right? And then at least give yourself some cash, all right? You can flush yourself back up with the cash you just spent, all right? You can flush yourself back up and give yourself some new cash again, okay? Just in case we go lower, all right? So on this bounce, I want you to be thinking about that because this is how you play it, all right? This is how you do it. You never assume you're going to be right. Always have a backup plan, all right? So just like we had 2 price targets, well, now we have a potential sell plan here, okay? Because I'm pretty sure we're going to get a bounce. Assuming we do, then this is an opportunity to reallocate your account and kind of weed out the losers, all right? Don't let yourself be diluted. And sometimes, you know, it's good to go ahead and take a small loss on something that looks like it's probably going to be a loser, right? And reallocate to that something that's really strong, right? Something you know is a lot better for the long term. So what's the too long didn't watch version of this in a couple of minutes or less? Well, first of all, the coming bounce that I assume is going to happen in the near term, you need to use this as an opportunity if you're over allocated into bad things or you have losers in your account. Maybe you found something on some YouTube video and you're like, oh, that's a great idea. And it turns out you have a lot of regret, right? You probably know what I'm talking about. If you have something like that in your account, you need to use this bounce as an opportunity to get as much of that back as you can so you can reallocate to the things that you've discovered are actually really good investments. Beyond that, understand that commodities are fundamentally bullish. Understand that the market is collapsing for a very particular reason. It's the debt market. But ultimately, in the end, this will likely result in quantitative easing number 5, which is just a lot of money printing, money of which will be devalued and will seek out real goods such as commodities, especially energy commodities and precious metals, as they use all this money to build a lot of infrastructure and everything they can to keep the economy afloat and to keep it from collapsing into a depression. And this, of course, will just be a major boon along with our artificial supply constraints that we've created for ourselves with all these sanctions, right? And it'll just keep not only the commodity prices afloat, but it'll extend them even further. Fundamentally very bullish, while the markets are bleeding blood in the streets and people are afraid to get into commodities. This is exactly the time you need to be buying. And if you are new to the channel, I would highly encourage you to go back and check out some of these prior videos like this one talking about real interest rates and theory of reflexivity, the Pareto principle, Wyckoff, and how all these things impact market dynamics and just the psychology of markets and day-to-day trading, and how they extend out even to the Ash experiment or the Hope experiment. And psychology just plays a huge role in the markets and how you can utilize this to your advantage. And we talk about, of course, how to use all these things. And really, the entire channel is a linear progression from one episode to the next, always picking up from where we left off, continuing on with the narrative that the market gives us and always trading around it, understanding, of course, that narrative trumps reality until the very end.